Welcome everyone to Alternative Risk Vehicles, a captive introduction. Thank you all so much for joining us. Today's presentation is being recorded and the recording will be available in Academy within 2 business days. As you have questions, you may post them in the Zoom Q&A and we will answer questions at the end of the call. We will try our best to answer all of your questions at the end of the presentation, but if for whatever reason we are unable to get to your question today, please email learning@nfp.com. At this time, I'd like to introduce our speakers for today's webinar. Joining us today is TJ Scher, Vice President of Alternative Risk Consulting at NFP, and Dale Sagan, Vice President and Leader of Group Captive Solutions at NFP. We're very excited to have them speaking with us today. It is my great pleasure to hand over the call to our speaker. TJ, the floor is yours.
Thank you, Amber, and thank you everyone for joining us today to talk a little bit about alternative risk vehicles and a captive, generally 101 session, as many people call it. Between Dale and myself, we'll walk through some different options as well as what's going on in the marketplace. My focus is on alternative risk solutions and building and creating customized captive programs, as well as finding the right fit for those that are looking to join other programs. Dale, I'll go ahead and let you introduce yourself.
Hi, everybody. Thank you for attending today. Dale Sagan here. I focus on employee benefits within NFP's captive practice. So helping advisors, helping employers, helping different point solutions come up with a strategy for captives that helps them with all employee benefits, most common medical stop loss, however. Now, I'm going to jump next slide here. A little quick disclaimer. We are not tax advisors. There's nothing in this presentation that'll actually constitute as tax advice. This is something that we just need to make sure that we are very clear in for legal reasons. Quick touch base on the agenda here. I'm going to hand this back over to TJ in a second, but when it comes to alternative risk, property and casualty, TJ is a vast resource for our team and for NFP. So when it comes to a lot of solutions, TJ Scher is a great resource. I am a component of this entire enterprise that focuses on employee benefits specifically, as I said. So this presentation is going to get into really the nuts and bolts of captives, and then we'll touch upon employee benefits later on in this presentation. TJ, hand it back over to you.
Thanks, Dale. So when we go through this program, we're hoping that these questions are thought about and somewhat thought-provoking as we talk about ideas, who may join a captive or start their own, and thinking about any program that you're interested in or you may want to join or currently have, and whether it's maximizing the output you're looking for. So some of these questions are rhetorical as we go through to be thinking about, hey, when I look at a program, do I want to own it? Is it sponsored by somebody else? What is the overall relationship between all the parties? And is the service and outcome to my expectation or being maximized, or could we do more? And then really when we talk about group or participation programs, does your vote count towards the program that you're trying to achieve, or are you okay with participating in a broader program? So Dale, if we could go to the next slide. When we think about who may join a captive or form their own captive, we look at savings and reward as well as the risk and variability. The simplest program for smaller clients is guaranteed costs. You're paying your premium and you're transferring all risk to an insurance program. So there's no reward, there's no savings, but you've fixed exactly what your cost will be for your insurance. As you move higher up the continuum, we start getting more creative and you have more options. This could either be due to the insured's risk profile, meaning willing to take more risk for more reward, or as your program and your exposures grow, you may be forced into one of these programs, meaning if you had $5 to $10 million of workers' compensation premiums, you may not be able to buy or want to buy a guaranteed cost program because you find that an experience rated or a deductible program is really more advantageous. When we start looking towards alternative risk, we look at pooling arrangements and we look at captives, whether it's in a group setting or in a single parent setting. But you can see as those move up, the savings is more clear and there is a little more risk, but if you're willing to take the reward, it can really maximize the overall value. As we know, and as Warren Buffett has proved, insurance companies are profitable. So why not take some of that profitability for yourself? We leave on here the self-insured. Really, no company in the world is self-insured. There's catastrophic bonds, there's insurance-linked securities, there's all these other vehicles that we're not going to talk about today that really does cap the exposures. Even those of BP or Walmart or Google either have a captive or are still buying excess reinsurance above certain levels. So while you could truly go self-insured for maybe 1 or 2 lines of coverage, you would never be solely self-insured. Yeah, if we could go to the next slide, please. So when we talk about different types of group captives, there's single parent captives, which are fully autonomous. Those are larger client solutions, and you're insuring the risk of the parents or the parent's affiliate. You are controlling it. You're the shareholder, you're the director, you're the officer. You're controlling that. We look at that as building your own house. You own your own land, and you're making all the decisions in that land. Moving to a sponsored cell captive is a great solution for either middle market or smaller companies with lower premium volume, or potentially for a single line of coverage. Some cell captives can simply be pass-throughs, meaning you're writing a policy from your cell to the parent, but that cell is really just utilizing the reinsurance market as a conduit. So there's potential to form a single parent captive and even a cell if it's more beneficial. But typically those are set up by a third party, such as NFP, in a bigger program, and you're able to enter and exit a cell very quickly and for generally lower cost than operating your own single parent captive. So we look at those as condos. You're buying a unit within a condo building, but some of the decisions such as maintenance and the hallways, the exterior paint color is decided for you, but via the condo, you're saving money in general. Moving over to the right, you have association and group captives. These are captives set up for members of an association or unrelated parties in a heterogeneous or a homogeneous group captive. Typically, those are going to be a P&C captive only, or as they'll talk about later, a health and wellness medical stop loss plan. But those are where a bunch of groups come together, a bunch of employers come together and try and consolidate the costs of running an insurance company, as well as de-risking themselves by sharing in different levels of certain lines of coverage. So they get the purchasing power of a larger group with by still maintaining their autonomy as a small individual employer. So those are, we look at it from, if you're not able to be rated on your own risk in the commercial market, by joining a group, you typically can. And then we move over to risk retention groups. Those are sort of like a group captive, but they have to be for very like-minded companies, and any insured has to be an owner and any owner has to be insured. So there's some caveats to forming or joining a risk retention group, but they do operate under a different insurance act. So the LRRA governs them, which gives them some additional autonomy in all 50 states from being licensed and being able to operate as their own insurance company rather than needing a fronting carrier or a national, call it AIG or Zurich or Traveler, someone like that. We see that a lot in the medical malpractice space or in trucking or auto liability. So providing these different solutions and working with clients and brokers, we want to evaluate as an employer, what is the best fit? And maybe it's one of these, maybe it's a combination, or maybe if we move up a slide, guaranteed cost or just simply a deductible plan could be the better option right now, but we definitely don't want to leave options on the table. Yeah, if we can go to the next slide. So we look at clients that should or may consider forming a captive. They sort of fall into 6 different buckets. And it can be one driver, or it can be multiple drivers that start the conversation and really push it through to the end. It could be coverage, as simple as not being able to actually procure coverage. I was reading this morning that cyber, as I'm sure many are aware, is very difficult to even buy now. If your internal IT systems aren't up to a certain standard, you cannot buy cyber insurance. So you may want to push some of that to your captive or some risk to help get some coverage that is not even available commercially. Or you may say, this cost for the cyber or another line of coverage is substantial and it's increasing over time and I've had no losses. So I'm going to take that policy out of the commercial market, or at least a portion of it, where it becomes the most expensive, and push that into my captive. There's other reasons for the capacity. I mentioned a cell having a pass through and accessing the reinsurance market, creating more capacity that's not available to you as a direct insured right now. Then there's compliance. Again, moving up retentions, but if you need to have a compliance vehicle showing a certificate of insurance for a certain level, you can create a captive to take on some of that risk. And then obviously controlling your whole program. So looking at it holistically and controlling every aspect of your program, that maybe there's bits and pieces in different affiliates or with different carriers or unknown retentions or losses. This consolidates everything really into a vehicle that you can track losses and better understand your true insurance costs. When we talk about broad sense captives, we also want to focus on things that maybe not everybody's talking about. And these are just a few, because every industry and every organization has slightly different drivers or opportunities that don't just get the catch-all in a deductible reimbursement plan that may be the simplistic out-of-the-box answer. So middle market programs, a lot of times when we look at what's going on, you start with a deductible reimbursement. That's a really great place to start, but you don't want to stop there, because there's a lot of items you can generate new revenue for the company, or you can have additional cost savings. So when we look at new revenue, we look at the contracting space. A lot of times insurance costs are baked into those contracts. But if you're taking on a deductible, you may not be able to get reimbursed for losses within that deductible. Or if you're taking on deductibles in real estate and you're camming back some of those charges, or in any other industry, but if there's a deductible you're not able to get reimbursement from, you can look to a captive to create an arrangement to still have the same amount of risk, but get reimbursed preemptively for that layer of risk. So we're trying to align where the risks are and when you're charging back rather than working in arrears. So we can get out front of creating new revenue, or even looking at reducing the expense of something you're not reimbursed for. On cost savings, we also look at those high rate online policies, meaning how much is the premium for the limits you're buying. And taking that into account with any buffer layer and retention analysis, you create sort of a matrix. And you start looking at where the percentage of rates change, or where they become very uncompetitive, or a buffer layer. In some instances, you have a gap where one carrier is stopping and another carrier refuses to drop down. So you may have a $1 or $2 million gap between layers as you move up the spectrum that you just need to buy insurance for that's not available. And so you could choose to, again, buy that for a very high rate online with another carrier, say $500,000 for $1 million of coverage, or you could look to move that to your captive and pay that same amount of premium. However, if there's no losses, you've saved that money. So the premium and your budget from day one may be similar to what you're paying commercially, but any cost that's saved at the end of the year is really driven by those low claims. So you're looking to actually create cost savings at the end of your year. And then we start to look at the industry. So obviously auto is really bad right now, property, and then private equity firms. I think a common misnomer is that private equity firms are bad for captives. There's a lot of creative solutions to get carrier implementation across different portfolio companies to create and isolate risks among a portfolio company and either pull it within a cell structure or its own captive to help drive cost savings and actually get a better multiplier on that particular company for resale value. So there's some creative opportunities to look through with those. So those are just kind of a few ideas that kind of fall outside of just looking for clients with high deductibles or insurers with high deductibles as being fits for captives.
TJ, I'm going to jump in for a second as well and just throw in, if you talk to a lot of captive consultants out there, they'll tell you that a driving force in the captive industry is medical stop loss. Employers, middle market employers that are typically stuck in a fully insured arrangement, joining up with others in a group captive is growing very fast. If you talk to any of the large captive managers out there, they will say, and even domiciles, they will say, that one of the largest drivers of captive growth also is medical stop loss, more employee benefit side as well. So I just want to sneak that in there really quick.
Yeah, that's a great point. This is more focused on the P&C side of things, not accounting for all of the benefits that is you're growing because of the same, the property and auto on the same side. The medical and inflationary costs are really driving people to look for alternative solutions. So we definitely don't want to discount that. That is a whole separate piece, which I'm glad Dale's going to have a lot of time to talk through different solutions for that specifically as well. When we look at how a single parent or cell captive works, a lot of this presentation is focused on creating your own captive or captive solution, but these are very common across joining a group or even a risk retention group. You can have a policy that is simply between the insured and the captive, where the parent pays premium, the captive issues a policy, and it's a very direct relationship. Most common in a deductible reimbursement policy or a policy that has no commercial interference. A reinsurance program is where you introduce a front. That is, again, your Zurichs, your AIGs, your Travelers, where the parent still pays that company its full premium, but a portion of that premium is then reinsured to the captive. And then that company would typically take an excess layer. So the captive may pay the first $250,000 of any claim, and then the fronting carrier would pay above that. The pros are that you now have a certificate of insurance that essentially shows zero deductible. So when we talk about passing through expenses, you're showing a third party's invoice and premium charge that you can pass through. The con is there's going to be that operating cost or operating expense because there is a front and there's some paper involved in providing those administration services. So when we look at which one's better, we look at what the requirements are. And then if there are no requirements, is there a cost savings or is there any other differential that makes one more appealing than the other? I would say the third that's not really listed here is where you have an insurance company behind the captive. And that is, again, the captive buys reinsurance to cover any maximum losses that it may take on or pass through. So the parent is covered both by the captive and by another insurance company. And when we look at lines of business, and we'll illustrate this in the following slide, but we look at the common lines of coverage. When again, we splice off a P&C group captive or just more, casualty, it's typically auto liability, workers' compensation, and general liability are the three main lines that are going to be in a group. And then, as Dale mentioned, you have a medical stop loss group. So those are usually autonomous and limited to those coverages. When you're looking at forming your own cell or single parent captive, you can put in as many or as few lines of coverage that are listed here or not listed here as you want. When forming an insurance company, you are just that. You're limited to certain license restrictions, but you don't need to create multiples of companies to insure various risks. You can put in your medical stop loss plan with your property and with your workers' compensation plan all into the same captive. And then it becomes, again, that collective risk management tool that is really set aside to better understand the risk and control the cost of what's going on. So when we think about that, remember, this isn't siloed. This is creating a vehicle that is catered to the insured. So this is that visual depiction. When we look at what may go in the captive, there's still going to likely be some kind of a primary carrier, especially for statutory coverages like workers' compensation or auto liability where they're required. You're going to need to provide some certificate of insurance. However, below that, we look at a retention, and it may not be the same for each line of coverage. You could change it from work comp to GL to AL. They could all be the same, but we're looking at funding those deductibles inside of the captive. The excess layer is another one that will sit on top of the primary, but there may be other layers within that become too expensive, both as the umbrella coverage or as you move up the property tower, where you may actually pick off different layers or quota share layers within those higher limits that seem advantageous. So this is a kind of a simplified depiction, but it's just showing that nothing's created or nothing's set in stone when you're creating your own program. Domicile Basics, there's many domiciles. There's onshore domiciles and there's offshore, which are the two common buckets. I believe it's 35-ish states in the US that have captive legislation, some more advantageous than the others. But then there's offshore. That is typically your Caribbean domiciles, Bermuda, Cayman, Barbados, the Bahamas. In general, they're very similar. You're going to operate almost identical, but some have pros and cons, either within the states themselves or even offshore. Capitalization requirements is a big one, as well as tax implications. So if you're going offshore, you may choose to be taxed like you're onshore, or you may choose to be taxed as an offshore entity. So we go through the analysis of setting up a single parent captive. You will be able to pick onshore or offshore, and we'll work through where those pros and cons may lay. Most group captives are located offshore because those jurisdictions are usually a little easier to get those groups off the ground and promote what they're trying to do. Some onshore requirements can be cost prohibitive or not allowed even under the legislation. So there are those two options. And then most cell companies are onshore or offshore. So Vermont has several cell facilities as well as segregated cells that would be offshore in sort of a Bermuda. Again, there's different pros and cons depending on the structure that's looking to be created and the ultimate goals of the insured. As forming or joining any type of a captive, it's not in a vacuum. The insured will look to have a captive insurance company that's going to have a captive manager, which is the oversight. That's going to be the accounting, the regulatory filings, kind of the primary point of contact of what's going on in the insurance company. But within that, any captive is going to have a board of directors, an appointed actuary. There will be domicile regulation, which can be onshore or offshore, tax, auditor, bank and investments, TPAs, and legal counsel. Now, this seems like a lot of people. However, depending on the structure that's in place right now, some of these may be new entrants or some of them may be already on the insured, meaning if there is already an audit and tax and bank and investment company or companies of the insured, they could be used for the captive. So it's not necessarily a new slate of individuals. We'll try and cohesively put together a program that makes the most sense financially and advantageously for what and where the captive is to get things accomplished. Questions usually arise of what happens to all of the premiums that go into the company. How do I get it out? How do I use it? Or what happens when it sits there? The premium payments come into the captive, and the most common source out is claims payments. That should be the biggest expense of any insurance company. Then there's going to be the other operational costs. But while that money sits there, before there would be a dividend to the captive owner out of any surplus, the captive and most insurance companies have investments. I know most corporations, just general entity industry corporations, shy away from having investments due to the double or triple taxation that happens. However, an insurance company is looking at having long-term assets that aren't invested in property, plant, and equipment. So the best course is to actually invest those assets. That can be done a few different ways. You can simply invest in an investment portfolio, stocks, bonds, and mutual funds. It may be more advantageous, if approved, to loan some of those assets back to the parent company, so the parent company can invest that in new property, plant, and equipment. So you would basically set up or treat the insurance company almost like a bank, set up a promissory note and pay interest back to the insurance company for lending those assets back to the parent. Or you may have other direct investments. So there are times where owning a hard asset such as land or such as equipment or some other direct investment into another company could be advantageous and a high reward. However, it has to be taken into account that that money wouldn't be able to be used for claims payments. So when working through this and as the captive manager, we have the discussions looking at what the minimum capital requirements are, what the future cash flows look like, and make sure the investment portfolio is structured as such that there wouldn't be any demand for payment or any lack of solvency or any regulator concern. So that's part of where our team comes in at NFP to help with these types of decisions for the short and long-term structure of the company. We've talked about a lot of the advantages for forming or joining a captive, and typically they're on the cost savings and being able to take better control of the insurance program. Obviously, the considerations to be aware of are taking on more risk. So if this is an opportunity to take more risk, there is more of a chance for loss. Is the balance sheet, or can the balance sheet of the captive and the insured support a larger loss than maybe what's taken now? If there is no change in the risk profile of the company, meaning the deductibles are the same, the claims would be what they would, and losses would have to be paid no matter what, you're looking at overcoming frictional costs. So if you set up a captive and go to all of the work of doing that, and there is a large loss that comes in that would have been paid by the parent anyway, then you've lost the frictional costs of the captive by still having to pay that claim. Now, that actually becomes one of the advantages if that large loss occurs in a later year, where the surplus can absorb that large claim without having it be a detriment to the insured. So it becomes that financing vehicle over time to take out some of those considerations of moving your risk profile to take on more risk rewards. But there are still those considerations. We look at the decision flow of either forming or joining a captive. It starts with just reviewing the current program, both what is the size, what are the losses, and what is the potential appetite of the current risk or to take on more risk. You jump over to a feasibility study if you're looking to form your own program, or if you're looking to join a group, you really create a submission and look at that group and understand where you fit in the group, what your size and parameters and the risk of that group are, and then kind of do almost an evaluation of what if you join that group. From there, you create the decision to proceed, develop the plan or create all the documents to join or form the company, and then really start commencing operations. Now, this window, depending on if you're forming a single parent company, forming a cell, or joining a P&C captive, really can be anywhere from a year down to a couple months. So it is wide open, but it's better to start step one as soon as possible to be able to allow as many options. Because as that timing starts to creep up and you need an implementation date, it's going to be tougher to be able to do all of the things on the table. So we want to start as soon as possible and start taking things away that aren't going to work, so we have a more pointed focus on what could work and have the time to really get to commence operations.
TJ, I'm going to jump in again just to be a little selfish here. I would overlay the employee benefit process over this as well and just say that the more time you can provide your captive consultants here to walk through the opportunity, walk through the business that we're going to be working on with this captive arrangement, the better you are. And I say that because there are sometimes, there's a bad renewal that causes some frustration, and the captive seems to be a solution that could make sense, but there's just not enough time for us to provide a solution. So engaging our team here, NFP's captive practice earlier in the process, even before the RFP and the renewal really begins, I think is advantageous for everybody.
Yeah, I think that's really helpful to remember, because within corporations, not every decision is made by the same person depending on the lines of coverage or the profile. And if we start step one too late, to your point, that we may not be able to get the benefits rolled into the thought process, whether that is over with human resources or with a different risk manager, or kind of falling under a different entity or tree within the corporation. If there is that need to incorporate more people, obviously that takes more time, and they may not have common renewal dates, so there may be a lot going on. So we definitely want to start early, and again, start very broad so we can start narrowing down the focus. So we look at the partnerships. Again, the ownership is starting your own single parent captive. That is choosing your domicile, total control. Disadvantages are a little more cost up front for the capitalization than ongoing, But the advantages are you're really driving your own customized vehicle that can change year over year. When you're looking at having a cell, it is minimal interaction. So it is for really straightforward programs that may have smaller premium dollars. So you don't need bells and whistles. You really just need the vehicle. So the disadvantages, if you want to pick a different auditor or pick a different actuary, may not be allowed because we're following a really streamlined process for that cell. When we go into participating, really you are just an entrant. You are just joining part of a program that's in place via an agreement. And so I really want to turn it over to Dale because a lot of the medical stop loss programs fall under that participating model. There are some groups and there's some other opportunities. A lot of them kind of fall under that. So Dale, I'll let you kind of run away with this one and talk more about participating programs within the NFP universe.
Thank you, TJ. Before I jump in here, I also wanted to provide a reminder for everybody. If you have any questions that you want to shoot our way, feel free to pop into the questions box and we can answer those at the end. And if you want to take anything offline, TJ and I are available to take those as well. So definitely interested in engaging with you during this presentation. And as TJ mentioned, participating cells, participating captive programs are very popular for medical stop loss. I feel like every month there's a new captive strategy, a new captive brand for medical stop loss purpose to help employers with their employee benefit plans. The majority of these are participating cells, and I'm going to give an example. This example is NFP's CaptivePlus program. It's a medical stop loss group solution for employers that are between 50, probably about 400, 500 employees enrolled on the plan that allows those employers the ability to usually self-fund for the first time. So those are employers that feel stuck in the ability to have some flexibility with your plan. CaptivePlus allows those middle market employers the ability to lean on each other for risk-taking purposes. We'll get into what that really looks like in a second, but using this example, I just wanted to share some advantages that the CaptivePlus program has in the market. NFP distribution is one of the strongest in the country. NFP is one of the top 5 employee benefit brokers in the world. So the ability to scale captive solutions is something that we are prideful of. NFP's risk management experts have a lot of resources at our disposal. The NFP team here, Heidi Cottle, Deb Smolinski, our actuarial resources. We have a lot of individuals that are experts in their field that are able to now work with those middle market employers at a closer level. So using a data warehouse to allow us to review the risks of this group captive, to provide solutions to the members of the group captive, to allow them the ability to have more of a say in the solutions that the captive is bringing to the table. So it really is allowing those advisors as well as those employees the ability to take better control of risk management within their captive solution. The independence from the stop loss market is an area where CaptivePlus definitely receives some kudos, because I would say that the captive market is growing quickly. And the stop loss market is looking at the captives as a way to expand their services as well. There are many stop loss carriers that are building their own captive solutions. There are many captive managers that are also building their own captive solutions. But I would say the independence from the stop loss market allows you the ability to really make sure that you are partnering with the right carrier, the right reinsurance partner, to make sure that you are getting all of the resources needed. I would say that the pricing of the stop loss carrier isn't necessarily as important as the resources and support that you are receiving through the duration, the long-term solution that you're putting forward. And CaptivePlus brings those solutions to the table. Glide path to new solutions is an area where NFP is going to excel. And I say this because TJ, our entire team here, our captive practice within NFP, have the ability to utilize different captive solutions to help grow your client. And what I say this by, if you think about the group captives out there, there's really one product that they can sell you, and it's their group captive. They don't necessarily ever bring new solutions in terms of a group captive for other lines of coverage. Or perhaps there's an employer that you're working with, and this employer has a lot of enterprise risk. And it's at a point where, yes, they are middle market in terms of their employee benefits team, their strategies for employee benefits that they're providing their employees. But I would say that there are many that actually could utilize a single parent captive solution, as TJ alluded to earlier. And that's something where this CaptivePlus solution, it really could be a jump-in point to begin your captive consulting with our team to see if a single parent captive solution is something that could be very advantageous to this unique employer based on their entire enterprise risk. So CaptivePlus will allow you to join and then leave if there's a solution that we are able to develop for you that is better for your client. I also want to bring up the community controlled nature of CaptivePlus. So really capping the enrollment of a captive cell around 50 gives those employers and advisors the ability to have more say regarding the strategies that are being presented. Those captive programs that have 200, 300, 400 employers, I really would question whether your voice really matters. And I think that the community control nature, the small captive programs for the middle market is going to be very valuable across the market here for MFP and our benefit partner members. So let's kind of get into this for a second here. So creating that predictability is something that is really impactful for larger employers. If you think of the Fortune 500 companies, the very large entities, many, as TJ said, are just completely self-funded. The reason why they could do this is because they have size, they have scale, they have predictability regarding the severity and frequency of claims. This chart does a really good job of showing this. When you are fully insured, or as our PNC folks like to call guaranteed cost, you are transferring all of this risk, predictable, unpredictable, to an insurance carrier. You are transferring that entire risk portfolio to an insurer. What I would argue is that retaining the predictable claims is beneficial for that employer. Those doctor visits, those drugs that are just an ongoing nature, maintenance medications, just outpatient surgeries. These are things that are going to happen in a population. It's predictable. Retaining those claims is advantageous because now you're not layering in commissions, fees, taxes into the cost of those claims. Now, the shared layer, this green layer here is what I want to point to next, is what I would consider unpredictable claims. But when you are banding together with other like-minded employers in a group captive, you can retain a higher limit, which allows you the ability to have more control over your renewals, making sure that you are forcing the no new laser rate clause, which can be removed at any point in time when you're purchasing traditional stop loss coverage. And what I would say is that shared layer allows you the ability to have leverage over the market. So that allows for those severe claims that materialize. The moral hazard that often happens with traditional stop loss is really removed from the equation. When 80% on estimate of your costs are variable, it's claims. So now you have a vested interest to try to find solutions that are going to reduce the cost of an ongoing claimant instead of simply a moral hazard, transferring that risk to an insurer, which is going to compound fees, taxes, commissions, and ultimately the underwriting profits that most insurers have to build in. This is what...
Hey Dale, just real quick, as we kind of talk about these splits, and you mentioned the PNC folks, how does this compare to sort of the PNC group captive that maybe more people are familiar with as it bridges across to just really a different line of coverage?
Yeah, what I would say is that every group captive out there for all lines of risks are set up different. Some have lower deductible limits, some have rules and regulations that you have to put in place to make sure that you are providing risk management solutions to reduce the cost of a claim. There are some captives out there that have what I would consider to be a high barrier of entry. And that's not only just for medical stop loss, but let's look at cyber risk. As you mentioned earlier, you have to have certain protocols in place internally for a captive to really want to work with you. That's no different on the medical stop loss side, where there are some captives that are really driving everybody to manage their risks, to take control of their costs, and before you are able to join the group captive. There are also captives out there that have a very low barrier of entry, which are really just trying to give you the opportunity to self-fund for the first time, not be disruptive to the employees. And that's a great place to start your captive strategy because it at least puts you into a self-funded game. But I would say over time, you will learn different strategies and learn from each other. So then you can start to steer down your costs, your risks, and provide more value through this captive. Does that answer your question, TJ?
Yes, it does. Thank you.
Good stuff. All right, so let's take a look at what this looks like on paper. An employer having the ability to choose their own captive or their own specific stop loss deductible. You have every employer here lined up with their own risk tolerances with their self-funded plan. What I think is the most popular model for a captive is the floating captive layer. And I say this because the advantages are that as an employer grows in size, they don't eventually grow to a point where they have to leave the captive. As you have this floating layer, as the employer takes on more risk by increasing their specific stop loss deductibles, the captive is going to take on more risk as well. That unlimited excess layer is transferred to a stop loss carrier, or in some cases, with some captives, the reinsurance market attaches at a particular level. And that allows for that floating captive layer to be the leverage that you have against the stop loss market and the reinsurance market to take on ongoing risks at renewal, to take on different terms that you feel like are important for you and your clients. I would say that this chart does a really good job of showing the level of size and scale that you have when you have a captive strategy to help your clients, those employers, better manage their risks. You're going to have some clients year over year that have rough years. You're going to have some that have great years. If you are the sponsor of a captive program, or you're a part of a captive program that's going to be transparent and allow you the ability to have a seat at the table during the underwriting process, it allows you the ability to really make sure that every employer gets as much value out of this as they would like to obtain. The risk reward paradigm is something that's discussed on a quarterly basis with CaptivePlus, and I feel like that's a best-in-class strategy for your group structure.
And Dale, if we could go back just real quick to that slide, I think it's really important when anyone's looking at group plans to compare and contrast. And you mentioned the floating layer. That's one concept. There's others that have sort of a fixed layer. Either it stops at 500,000, you can pick a retention, or most P&C captives have your A fund and B fund that are set by the group. So whether you are paying $400,000 or paying $5 million to that same group, is just getting bucketed within those same retentions. So where you may choose or want to take more risk as an organization, you're not allowed by the constraints of the group structure. So I think anybody entering in has to take that short and long-term view of where they find their risk profile currently and in the future with growth plans or acquisitions that may either make it more advantageous of one program or really take all programs off the table because of the plans that they may have. So I think this is a really good visual depiction that should be laid against any options that are considered, including current plan or the fixed cost or anything out there, is really taking these side by side.
Mm-hmm. Great point, TJ. And you can even expand on that into different quota shares that are out there, where you have the sharing of risk within that floating layer. There's a lot of ways that you can make the captive to be very, I guess the best way to put it is difficult to understand, which really puts the power and I guess the leverage back into the stop loss carrier markets, the actuaries that develop these to be very profitable. So there are a lot of captives out there that I would say the more complex they are, I would say the more benefit the stop loss carriers have in the marketplace. When it's something that's very cut and dry that everybody can understand, usually you're going to get more value out of it, in my opinion. All right, so let's just talk in general. Well, what makes a captive for a medical plan advantageous? I'll touch upon these quickly because I think I already sprinkled a lot of this in. But if you look at the Kaiser Family Foundation, 84% of employers over 200 employees on their plan are self-funded. I would say that that's a strategy that's time proven. For ever since ERISA was passed, you have employers that are self-funding their health plan. The larger you are, the more opportunity that you have to better finance your health plan. So what the captive does, the group captive, is it allows for those employers the ability to connect with a market that's interested in writing their business. If you look at any of the stop loss carriers out there, I know NFP has a centers of excellence for the stop loss markets. A lot of those stop loss carriers don't have an interest in groups that are under 200 or groups that are currently fully insured. It's a market where it is peeling back the opportunity for those employers that are 50 to 200, I would say. So this gives those employers the ability to take advantage of self-funding in a protected environment, which can give you the ability to have the transparency, control. Accounting functions are going to be something that you also want to consider. I would say this is the opportunity to self-fund. The greater economies of scale is something that's really important with a lot of these captives. You're banding together, and the underwriter is going to now look at you as one large employer. Yes, sometimes they have to individually underwrite you to make sure that it makes sense for their manual. Absolutely understand that. But what I would say is that you have enough leverage now where you can actually take the entire size of this captive program to a stop loss underwriter, and they're going to try to go after the business even harder to make sure that they either retain or earn the business. I would also add in the service providers, the ability for your captive, your group captive, let's say 2,000 total enrolled employees on the plan. You now have the ability to band that together to look for different service providers that can provide value. It could be a PBM, pharmacy benefit manager that gives you the ability to now work with all of your 60 life employer groups instead of just the ones that are over 200. I would say the reduction in overhead and insurance profits is something that I already hit upon, but it is an area in which when 80% of your costs are now variable claims, you're reducing a lot of the insurance profits, a lot of the overhead that is normally associated with buying insurance. The community is something that you're going to hear a lot about in the captive space. And I would say every captive is different, but most of them have their annual retreat where they bring everybody together into a room and they allow those employers the ability to build relationships, share their stories, share their solutions so that others can hear it. I've often heard this called as a risk sandbox that you'll bring individuals together into. And that allows for those employers to have more retention. It allows for you as an advisor to feel comfortable knowing that these employers are really engaged, and an engaged client is a better client. And I would also add in that buying insurance is no longer the focal point. As I mentioned, the fixed cost is reduced to a point where now the annual meetings, your quarterly meetings, aren't a hard-driven message with the controller, the CFO, really concerned about the annual 10% bump that they have in their medical plan year over year over year. Now you're looking for strategies that are going to enhance benefits, reduce costs, provide your employees a better communication pattern so they know exactly how to use the healthcare system in a manner that is advantageous for themselves and their employer. That's something that's very important, and a lot of captives try to enhance their service models around those solutions. Here are a couple solutions, captive models that I just wanted to throw out here. Our team has expertise in helping employers come into a captive solution, low barrier of entry, and that's what CaptivePlus is. It allows for those employers, fully insured, self-funded, to join up with each other to take advantages of the scale that they would have. I would say the high performance medical stop loss group captive is an area in which those employers that eventually get to the point where they say, you know, we really are doing a lot here. We have a carved out third-party administrator. We are looking at narrow networks, maybe a direct contract with a hospital system. You are doing something very special to manage your risk. So you should get the underwriting credits for that. And group captives allow those employers the ability to band together to take better advantage of the strategies that you're putting in place. Reference-based pricing is an area that's growing fast across the country. I know there's certain niches, it's still a swear word, but I would tell you that reference-based pricing in a group captive makes all the sense in the world. And I say this because a lot of the stop loss carriers will tell you that that is the most profitable segment that they have in their book of business. I will also tell you that that is a very volatile area in which those employers sometimes have the forbidden balance bill. You'll hear this every once in a while. But if you have leverage and you have size and you have scale in your group captive, you can make sure that you're protecting your employers that are a part of this group captive. So that's why a reference-based pricing medical stop loss group captive solution makes a lot of sense. And then the other solution that we are often working with on our team is insert brand here. So different advisors that have a unique skill set. They have a unique background and an affinity towards some type of industry vertical or something that they want to wrap a group captive strategy around their solution. So this is an area in which we're helping a lot of advisors bring additional value to their markets. And we're also helping employers that are interested in creating a solution for their benefits, not necessarily something where they are simply just buying and selling insurance. What I would say is finding your group of employers that can band together to take advantages of the scale that this brings. And, you know, common analogy that I bring up is if you look at McDonald's and Burger King, you know, they're usually right next to each other. They're right next to each other for a reason, because they want to make sure that they are getting all the advantages of an intersection that's very busy. If one were to be way down the road, you may actually be cut off. And at that point, that's going to be difficult for your business. So banding together with friendly employers just like you makes a lot of sense. And that's something our team is designed to work with. All right, TJ, that was a lot. So I'm going to hand it back over to you to take us home.
Yeah. All right, I'll totally simplify things. As I foreshadowed early on, is one or more solutions may be appropriate for any insured. And when we cascade them across what's going on, where the future holds, you may end up with really three options. You may join a P&C group captive to help get the pricing you need for the AL, the GL, and the work comp exposure, because that's the best option for those three lines of coverage. You may join, as Dale mentioned, all the advantages that come with a medical stop loss program. But both of those are still going to have risks. They're going to have either potential assessments or retention, and it's, for most companies, only covering some of the lines of coverage. So when you add those two together, you may get a third option, which is starting your own single parent captive or sell, and then utilizing that new facility to really de-risk the insured of the P&C group and the stop loss from any other risks associated with assessments or, as I mentioned, deductibles, and putting that all into one vehicle. So that's going to really help drive and control the total cost of risk across all the programs and really get that total balance sheet transfer over to the captive and get any financial efficiencies and cost savings that go along with it. So looking at it from these creative angles, you can see we've evolved a lot from just moving a guaranteed cost program up to a deductible. Now we're implementing several solutions that collectively provide a very valuable tool for the insured. So Dale, if we want to kind of go into the next slide, and I think this goes to one of the questions that's out there, which is asking about a property captive, and what are minimums? That's something that we have the resources to look at, and there's not really a straightforward answer because every insured is going to be slightly different, and sometimes the metrics aren't what you think. It's not necessarily payroll or revenue, or in this case, total insured values. It comes down to what is the industry, what are the losses, and what are the premiums that are paid currently versus what could be saved if there was more retention taken. And does that amount of savings come up to enough, call it maybe $500,000 in sort of the P&C world, of saved premium that you would look to fund a captive with? So we have to really look more than just one question deep to make sure that we're finding the industry and the basis of why we want to look towards a captive. I will focus on properties for a second because that was the question, is looking at just a single line of coverage may also not really add the value that it may be seen, because if you're going to save, say, $500,000 off of a property premium in the commercial market, what is your new exposure? Is that $1 million retention each and every, that you now have only $500,000 to fund all of those claims? Or is it even more catastrophic? So when we look to the captive model, we also have to see if not only the premium makes sense, but does the limits and the retentions, and then like any good investment portfolio, are we spreading the risks across possible other policies? So if there's a good year for one policy, does it offset a bad year? Or what is the projected surplus over time for any one of these given policies, and then adding them again collectively? So really that's where we're focused on taking our team and developing with brokers and advisors and insureds the right customized program that fits the needs of the insureds without just stopping at, here's your solution A, B, or C, the pick a door solution. So with that, we kind of want to thank everyone for joining and listening to us. I know sometimes that's difficult. So we appreciate the time, and we'll be happy to answer any questions with the remaining couple minutes or any follow-up.
All right, Amber, take it away. Thank you, everybody.
Thank you, TJ and Dale, for sharing your valuable time and expertise with us today. To reiterate, we recorded today's presentation, and the recording will be available in Academy within 2 business days. Finally, at this time, I'd like to take a moment to ask you to take a short survey today. The survey will populate in a new window when you exit out of Zoom. Please take a brief moment to complete the survey, as it lets us know what topics are important to our listeners and helps make our education program as current and relevant as possible. That concludes our webinar for today. Thank you, everyone, for joining us, and have a great day.